Moving over to the steel side, really much of the same here, although again, the declines are slower than what we've seen over the past. Markets have continued to move lower, whether we're looking at North America in the white line, Europe in the blue line, or China in the orange line. That being said, there has been a heavy amount of price convergence between the three regions. When that happens, you often would expect to see imports decline, and we are certainly seeing that. If we went back to March of this year, flat rolled steel imports were annualized running right around 14 million tons. If we fast forward to now, I would say that number is going to be closer to about 8.5 million tons. So certainly imports of foreign material coming in the United States has come down, and that's largely because the gap and the arbitrage from foreign markets to our market has really closed up. There's also the element of, similar to aluminum, there is a point at which you can get so low with prices that it becomes somewhat economic for steel mills to continue to produce. And if we use busheling scrap as a proxy, which we've done in prior Cup of Joes as well, and we take busheling scrap and we add on some arbitrary number of 300, which maybe represents their cost of labor, their cost of energy, their cost of processing, and their own margin, it would suggest that U.S. steel futures are actually somewhat in value territory. Again, this is not investment advice. I'm not saying go out and buy steel futures, but it certainly looks at, if we use that as a proxy, steel mill margins are getting tighter given where we are on a pricing standpoint. And one other piece of evidence I would have that would support that would be this chart, which is capacity utilization. Again, that's the percentage of available production capacity that is actually producing. It peaked out, I'd say, mid-summer of 2021, and ever since then, it was gradually declining. And then for the last 3 or 4 months, it has been rapidly declining. And we're back down to levels that we really didn't see since, well, prior to the COVID lockdowns, didn't really see since like 2018, 2017. So we're right around 72.5%, 73% of production capacity that's operating. And that's what happens when prices get so low. The response that the mills will take is they'll say, we'll make less of it. And because we're not doing so as profitably as we used to be able to. Now, I know some of our customers on the call are probably saying, well, cry me a river. You guys had a phenomenal 2 years. So what? Well, the so what is, I mean, these are free markets. They're allowed to balance that production versus profit equation the way they want. And they are certainly attempting to do that as we sit here this week. And it's worth noting that, despite the fact that prices have come down rapidly, production utilization is down at these levels, steel mills have almost in unison announced price hikes. So we've now got Nucor, US Steel, Stelco, pretty much all of them at this point have announced a $60 per ton price increase. I believe it's effective immediately. So that in effect puts the spot price for hot roll somewhere around $700 per ton. Is that an effort to slow the bleeding, or is that an effort to say we actually think the market is going to improve? I don't have the answer to that, but that appears to be their goal. Is they're saying we're not making as much money as what we wanted to. We've brought down our production to a level where we think we've balanced supply demand conditions, and thus we're going to announce a price increase on carbon sheet. We've talked about this chart, but I don't think we've shown it in chart form thus far. Many of you may have seen this before, but ultimately this is just looking at the historical spread between hot roll coil and cold roll coil. Cold roll coil is really just taking hot roll coil, running it back through the rolling machines, and giving it a better surface quality. It typically does come at a premium, but generally that premium is not quite as historically that premium is not quite as large as what we've seen over the last couple of years. The long-term average, I would say, is somewhere closer to about 100 to 150. We have recently, in prior, the last year or two, seen this spread go all the way up to $650. Fast forward to where we are today, things are beginning to normalize. Like many markets, things are beginning to normalize, and we've quickly seen the cold rolled to hot roll spread come back down close to $250. I don't see really any reason why this trend wouldn't continue, and we continue to push back into more normalized ranges, like many other indices and markets that we watch. So again, I would expect this trend to probably continue, and we continue to see this spread moving back into more normalized. I'm not saying we go all the way back to 100 to 150, but something back down to earth seems to make some sense here within this market. And then lastly, on the carbon side, I'll throw myself under the bus and say I've been wrong here. And again, if you're early, you're wrong. If you're wrong, you're early. This is showing the plate price relative to the hot roll coil price. And we're back into a situation by function of plate prices just kind of staying where they were and hot roll prices continue to drop, that the spread is back to almost $1,000 per ton, which is just a staggering spread when you consider the idea that really, for the most part, the production process of making plate is for the most part the same. That being said, I'm not going to take a victory lap. I've already thrown myself under the bus, but it is worth noting that just this week, at least one steel mill here in North America did announce a price decrease on plate. And that price decrease is $140 per ton. So, I would come back to this idea that it's not common that steel mills announce price decreases. They're very active and very, very open to announcing price increases. It's not often that they come out and say, we need to drop prices. I'm not trying to be too cynical here, but that would suggest to me that they're seeing things softening up fairly quickly in the face of new production capacity coming online from Brandenburg and other places. So even though we aren't seeing it yet, I would expect this trend to very quickly correct. And what I mean by correct is I would expect the spread between the two markets to converge, whether that's a function of hot roll coming up a bit, plate coming down a bit, or the combination of the two. I think this spread is going to rapidly tighten up on us.
So Nick, earlier this year, we had Brian Crane on who addressed this very topic, right? And what he said is some of those leading factors are fewer plate producing mills, right? But then very specific demand, we can call it, like from things like the infrastructure bill coming online, things like that. Could these decreases, or like you said, like maybe an anticipation of a softening, speak anything to maybe not being as optimistic about that infrastructure work coming down the pike?
Yeah, I mean, it could be a situation where even though the infrastructure work is continuing to move on, other consumers of plate are weakening. So it doesn't have to mean that infrastructure itself is falling short. It could mean that it's another tangential industry that's just not holding up its end of the bargain. I can tell you, based on the noise outside my condo, there's still plenty of infrastructure going on within cities. But yeah, I do think that there's a realization that the market is slowing, and this type of pricing and this type of price premium over the carbon sheet products really probably doesn't make sense, and doesn't hold really much of a fundamental argument if things soften up.